Hello again, everyone. This is Gene Ahrensberg coming to you on Sunday, July 1, 2012. Well, gold finished the week up 1.6%, near $1,600, and silver answered up 2.3%, but not before giving the $26 implied technical support a good test. Nobody expected very much from the EU Summit number 20, so when there was an apparent breakthrough, a breakthrough that signaled that the European equivalent of QE was in the cards, well, the US dollar tanked. The heavily short euro caught a 200 basis point plus rocket launch bid, and commodities knee-jerked higher across the board. Everything that was getting crushed did virtual 180s: oil, gold, silver, platinum, and especially copper, which popped a net 5.7% for the week. Moving to the subscriber pages, we are going to be looking at some amazing charts and trader data today, and we hope you'll find it as interesting and as compelling as we do in a contrary sense. We're going to focus on just one topic for this video, the Commitments of Traders report issued by the Commodity Futures Trading Commission, the CFTC, on Friday, June 29th, which captures a snapshot of the positioning of the largest traders of silver futures. Now, to put what we're about to review in context, remember that the COT report cuts off for reporting at the close on Tuesday, in this case, July 26th. Silver had survived one attempt to break it the day before, testing the $26.50 minor support, closing a little over $27. So all of the data and positioning we're about to review occurred before the major test on Thursday of the most important support at $26. It reflects the large trader positioning with silver under heavy pressure. We think it's important to note that the bounce up off the $26.13 nadir occurred prior to any word coming out of the EU summit. Now, before we leave this chart of silver, notice that the short covering rally on Friday ran into determined opposition just a little higher than its recovery on Monday, June 25. Moving to the legacy COT data, the legacy COT combines the commercial traders into a single category. So the producer merchants, processors, and users are combined with the swap dealers and perhaps some of the other reportables from time to time. What we are focused on here is the positioning of the largest hedgers, the people who have to hedge metal in hand or on order or in storage, and so on. There are lots of people engaged in hedging, but a goodly number of them trade through or have their positioning managed by just a few large traders. We focus on the hedgers and we track their positioning every week, and we attempt to gain a trading advantage by understanding the personality of the charts, which can be built using this very important COT data. Then we try to view it in context with our technical charts. But I'm getting a little ahead of the story. What that last line of data tells us is that as silver fell a big $1.32 or 4.7% Tuesday to Tuesday, testing the $26.50 area and then closing near $27, the traders classed as commercial, the big hedgers, covered or offset a very large 4,943 contracts, or almost 30% of their entire collective net hedge book in 1 week, to show a historic low 12,011 contracts net short, which we call the LCNS. I say historic because that is the lowest LCNS since way back on September 10, 2001, before the bull market for silver was underway. It is a bull market record low commercial net short position. Let's look at the chart. Look at that. With silver having merely tested the near support of $26.50 and not yet having tested the critical $26 support, the LCNS falls to an 11-year record low of a little over 12,000 contracts. The last time that the combined commercial traders showed such a low net short position in silver futures, it was the day before the cowardly attack by Islamic lunatics on the Twin Towers of the World Trade Center in New York, the Pentagon, and heroes on board American Flight 93 terminated that threat near Shanksville, Pennsylvania. That's how long ago it was. It was about a week before the terrorists sent letters laced with anthrax spores to newspapers and TV stations, killing 5 people and frightening a nation. Our world got a lot scarier then. And the price of silver then in September of 2001, $4.18 an ounce. So as of Tuesday, with silver near its support of $26, the people who have to and need to hedge silver in a big way when they feel the risk is to the downside were about the same amount net short as they were before the silver bull market with $4.18 silver. And isn't that about the same thing as saying that the big hedgers are not positioning for much more downside? Now, since Tuesday, silver has tested as much as 98 cents lower. So it's actually possible that the combined collective hedgers actually went net long silver by Thursday's close, which is simply amazing to those who have tracked the data as closely as we have for more than a decade. It is not quite as simple as it seems at this point because, as we'll see in a moment, a big reason for the super low LCNS is because one class of commercial trader is now record net long. And we'll look more closely at them in just a moment. Back to the data. Now we compare the legacy commercial net short position with the total open interest each week. And we think that gives us a better understanding of how aggressive the hedgers are. We call that the LCNSTO, or the relative commercial net short position. Notice, please, that this week the plunge in the LCNS has resulted in the LCNSTO falling to a historic bull market low of just 9.5% of all COMEX contracts open. And here's the LCNSTO chart. Going back to the year 2000, we simply cannot find a time when the relative commercial net short position was this low. This next chart goes back 12 years to 2000 for reference. So, the big hedgers as a group are at historic bull market lows in net shortness, which indicates that they're not positioned as though they believe that silver has a great deal of downside in it. If the big hedgers felt that silver was about to plunge off the delivery truck, shouldn't we expect them to have a larger net short position? Instead, with silver at important support, they are at the least net short silver in more than a decade of futures data, according to the Legacy COT report. Right or wrong, what these data suggest is that the silver market is oversold, it's skewed short as it were, and it's therefore ripe for a massive short covering rally. That's our take. That is, unless the short side can get silver to break convincingly below the implied support at $26. Then the shorts have become emboldened, and the record low commercial net short position would quickly morph into a new era of net long hedgers. But that's not the entire story for today. Let's look a little deeper into the data courtesy of the CFTC Disaggregated COT report, or what we call the DCOT. Each week we publish the weekly changes of the Disaggregated COT report on the blog. From that DCOT data, we can build charts to visually reflect the positioning of all the classes of traders which the CFTC provides. Briefly, because we've got more important fish to fry today, the data for this week shows that as gold fell a net $45, the traditional hedgers were in a mood to cover or offset a good portion of their existing net short positions in gold. In fact, the swap dealers almost went net flat gold, with gold in the $1,570 range. They probably went net long gold as it tested the 1550s on Thursday. At the same time, the sell-off caused the funds and the smaller traders to bail from more than 21,000 contracts of gold net longs in 1 week. In silver, it's kind of the same story, only more so, but instead of covering it with just the table, let's look at some of the charts that tell the story so much better. And by the way, we record these videos in HD format, so feel free to use the highest setting. And you can also use one of the larger view options on the lower right part of the YouTube viewer. Our first stop is the DCOT graph for the producer merchant traders, which includes the bullion banks and the largest bullion dealers. This category contains the most consistent hedgers, the big sellers as we call them. And as of Tuesday, June 26th, the big sellers came in with 31,692 contracts net short silver futures, about 158 million ounces hedged. By comparison, on February 28th, with silver then near $37, they were net short about 227 million ounces then. Now, the producer merchants are always net short, so the positioning shows as a negative number on the graph. So as that blue line rises, their net short position is getting smaller, and vice versa. As anyone with eyes can see, the big hedgers and the bullion banks are near their lowest net short positioning since the depths of the 2008 panic. Notice also, before we move on, that the highs for the blue line, which are actually lows in the producer merchant net short positioning, have often corresponded neatly with important lows for the price of silver, shown in pink. But one might say, wait a minute, the producer merchants are close to the lows in net shorts in years, but at 31,692 contracts net short, that's almost 3 times the legacy LCNS, the combined commercial net short positioning. And that would be right. So let's see a part of why in the next graph, the positioning of the mercenary swap dealer commercials. This is the net positioning of the swap dealers, and one look at the graph confirms that the swap dealers are now at their most net long positioning in the history of the DCOT dataset, which goes back to 2006. We've never seen the swap dealers this net long. The swap dealer net long position accounts for why the LCNS, the combined commercial net short position of all commercials in the legacy COT report, is at a bull market record low of just over 12,000 contracts. We combine the producer merchants net short, 31,692 lots, and the swap dealers net longs, a record 19,681 contracts long, and that gets us to the record low LCNS. You know, the swap dealers earn a spread by selling swaps in other markets and then hedging those swaps with futures. So when we see a very high swap dealer net long position, it means that they have hedged short exposure elsewhere. So we would expect this long position to increase as silver goes lower in price and decline as silver goes higher in price, because their counterparties would be covering their bets on advances and vice versa. We think a high net long swap dealer position indicates a short bias to their swap trades with counterparties. We also think it could mean extra long horsepower in the overall silver market once it gets a convincing bid, because the swap dealer counterparties are primarily hedging. That takes us to the next position, the managed money net position, and here we see another extreme 5-year low position, because as of Tuesday the funds reported holding just 2,414 contracts net long, their lowest net long positioning since September 11th, 2007, when they then held just 860 contracts net long, and silver was then $12.57. And here is where it gets really, really interesting, because that graph makes it look like the hedge funds and other normally net long specs have sold off almost all their long positions in silver futures. Well, it may look like that, but there is a different story to tell here. The interesting part is how the managed money traders got to that extreme low net long position, and it just may be the key to the silver futures city, so to speak. Pay attention, because the funds got there by adding shorts more than selling off their long positions, as this next graph reveals. What we're looking at now is just the short contracts for the funds, managed money, and they are at a DCOT record high of 16,684 contracts short. Up until about 12 weeks ago, April 10th, silver was $31.76 then, there was nothing remarkable about the big specs short positioning for silver futures. But over that roughly 3-month time frame, while their long positions varied roughly 1,000 contracts either side of 19,000 contracts long, managed money traders added more than 10,000 short contracts, up to the record high short position shown in the graph. Very high managed money short position in isolation tells us that either the spec funds are now positioning for lower silver prices because they feel like silver has a better chance of going lower, or it tells us that they're using the short contracts to hedge their existing long positions, or maybe a little of both. But one thing we can point to in this graph for guidance is that in the past, when the managed money traders did put on a high short position, as in higher than 10,000 contracts like right now, it corresponded closely with an important low for silver futures. Now, to our simple way of looking at the data, that can only mean one thing: that the managed money traders are using futures to hedge their long positioning, and that, friends and fellow vultures, is the highest of high-octane rally fuel for when silver does finally catch a meaningful bid. Now, the uber-high managed money short positions are out of necessity. In every single case in the past that they've been there, and they've been that high, when silver has been pummeled. But as soon as the second most popular precious metal quit going down and reversed, they covered them as silver moved higher. Those managed money short positions are like buying pressure in waiting. Or as my favorite uncle used to say, they're like lightning in a bottle. Now, friends, there's so much more to tell you about the legacy COT and the DCOT, but there's just only so much time we can use on a video. And now, armed with much more detail than most people ever get a chance to see, let's look again at the legacy COT LCNS graph and use the context of what we've learned today to take one last look at this historic, amazing setup for silver futures. And here's the silver LCNS graph. And in summary, we have a bull market record low net short position for the traders the CFTC classes as commercial. That's the combined commercial traders. Not since the day before 9/11, 11 years ago, have we seen such a low combined commercial net short position. We know that in the past, extreme lows for the LCNS virtually always corresponded with not just lows for silver, but important turning lows. And a turning low is simply an important low, not merely an interim low. We know that as the LCNS rises, it suggests that the big hedgers are becoming more convinced that silver is set to fall in price, and vice versa. Or maybe a better way to say it is that as the blue line rises in response to higher silver prices, they become more motivated to hedge their metal and positions against lower prices. And as it falls, they are positioning less and less for lower prices. Therefore, the very low bull market record LCNS today suggests that the largest, best funded, and presumably the best informed industry commercial traders, the big hedgers, are the least positioned for lower silver prices they have been in 11 years. The lowest since silver was $4.18 an ounce. Finally, we know that a big part of the low LCNS is because the mercenary commercial traders called swap dealers are the most net long in the history of the DCOT, and at the very same time the usually net long funds hold record high short positions, both of which represent pent-up buying horsepower. It's waiting for a signal, a sign, a convincing bust out of the relentless downtrend silver has been in for 4 consecutive months. That's what we do know. What we don't know is if these veteran professional traders are right put the word right in quotes. We can't see the future any better than anyone else. It hasn't happened yet. But if the past is prologue to the future, we do know that the setup today is about as contrary bullish the COT can get. Moving to the 1-year daily subscriber chart for silver, the silver market could very well be at an important inflection point right now. With that in mind, we've taken our long position here at and just above the green, which indicates our expected zone of important support, the green does, going all the way back to January of 2011. We think the COT is skewed short and at important support right now. So the near term could get very volatile in an explosive way in either direction. The COT data gives us high confidence. But we can also point to other important data, and we have in the notations we insert into these graphs each week. Obviously, we expect the outcome to be a massive short covering rally, and soon, or we would not have put on a long position here. But as always, our position includes the trading stops mentioned in our technical charts for subscribers on the subscriber pages. Let's look at the longer term chart. Now, before we go any further, here is where we add that this is our own positioning. Everyone has to decide for themselves where and when to trade. Longtime vultures will recall that silver fetched up above our buy targets in January 2011. So, except for our physical holdings of silver, we ended up sitting out the great run from $26 to $49 right after booking our largest single trade profit of $8.50 the ounce in the trade from August of 2010 to January 2011. Then we waited and waited for what seemed like an eternity to attempt another trade, and finally in December of 2011, nearly a full year later, we re-entered as silver entered the green near $26. We took a shot then with silver testing implied support and the COT wildly contrary bullish. Vultures will recall that that trade resulted in our second largest profit ever of $8 an ounce when we were stopped in early March. Well, here we are again, taking our shot with silver in the very same support zone, but this time the trade stakes are higher. The chance for failure is maybe a bit higher. The COT is even more contrary bullish as it was in December. Sentiment among traders is even more lousy as it was then. Silver has been in a giant flag correction and consolidation for more than a year, so the momentum is entrenched to the downside. As contrarians, we gotta like that setup. When the bears are overconfident and when silver is at critical, well-known support, we should have some company in our attempt to game the short-term price. So, as carefully and methodically as we have set up this trade, and as confident as we are to enter it, the fact is we and the big traders we track on the COMEX could be wrong. Something out of the blue could occur tonight or tomorrow or next week to change everything, just as it did on September 11th, 2001. You know, Jim Rogers of Rogers Holdings is famous for saying that he just waits patiently until he sees a pile of money sitting in a corner somewhere and he just scoops it up. And by that he means he waits until something has gotten relatively dirt cheap or he doesn't buy it. He's smart enough to know that speculators work best when they study the markets daily but only trade rarely, when the odds are very strongly in their favor. Successful speculators pick their spots, and they pick them carefully. They don't try to trade every day, or sometimes even every year, and they're in it for the big score. That's why we waited from January of 2011 to December to attempt a new short-term trade in silver futures. That's why We use trailing stops instead of crystal balls. Stops work when we're wrong. They keep us out of big trouble. Crystal balls don't really work at all. And if we're wrong, if we got this trade wrong, if the support doesn't hold and silver is going to crater, we want out. We want out to the relative safety of the sidelines with our leverage trades. We want to live to fight another day. In closing, let us remind everyone that everything that we've talked about today has absolutely nothing to do with our holdings of physical silver, which are just not for sale. Our short-term trading is for fun and for profit. So we might be able to buy some more physical silver. And when you think about it, if we end up being wrong with this short-term trade, we might end up winning even bigger. Why? Because that would be a great time to add physical silver, say under $21 or so, if the trading gods were so benevolent as to provide us with that golden opportunity. Okay, that's it for this special look at the silver COT. I hope you found it interesting and informative. Good luck, good trading, and good vulture bargain hunting. Bye for now.